Let's talk more about the markets with Mona Mahajan, Senior Investment Strategist at Edward Jones. And I like this here, Mona, and I'm going to read a quote. We would expect ongoing volatility in the markets, and I guess you mean difficulty moving higher, until a bottoming in earnings revisions, inflation more meaningfully rolls over, and the Fed moves to the sidelines. All related, obviously, but just that could happen at any time. Or do you think when could that happen? What's your best guess? 6 months, a year, what?
Yeah, thanks, Joe, and thanks for summarizing my points so clearly there. I think generally we're still in a position where markets are trying to fight the Fed here, and we think probably mid-year is a reasonable assessment where, one, the Fed could potentially step to the sidelines at least and not keep moving rates higher. But that would only happen in a more meaningful way, and markets would only have a sustainable recovery in a more meaningful way if we also simultaneously see inflation moving meaningfully lower. And that would mean not only goods inflation, which has started to roll over, housing and rental inflation, which we have seen real-time signs of softening, but we'd also need to see that wage component, that non-housing services component, start to stabilize and move lower as well. Now, we would be cautious to extrapolate such a strong January jobs report to the rest of the year. We do think there is some softening coming, but we'd like to see that materialize in the months ahead. And then the third point you mentioned on earnings, I think that's an important one, too. We've seen earnings be substantially revised lower for 2023 already. 10% plus was the estimate just mid last year. We're down to sub 2% already. We think there's probably a little leg lower to go there as well. We'll probably get somewhat into negative territory on 2023 earnings, but we're in a bottoming process in that as well. So we think things are coming together nicely, but we would expect volatility, as you noted, some sideways movement, periods of consolidation, until those things come together and perhaps set up nicely for a more sustainable recovery in the back half of the year, or towards the back half of the year.
It's tough to be right about the direction and the duration, so I'm not going to ask you that. But do you think we test the lows, the October low, or did October really, was that a bottoming process that's long-lasting, or do we break through 30, I don't know, whatever you want to call the low, I guess 3,600, 3,560, whatever it was? Do we test that and go lower, or does that hold?
You know, we think there may be a credible scenario where we start to test the October lows, but we don't think we go much beyond that. In fact, you know, if you think back to October, yields were also above 4% on the 10-year. We were going through some volatility because the Fed was back on the table. It's a similar scenario, but we think this time around we're closer to the end of this tightening cycle than we are towards, you know, the midpoint where we were back in October. So we think we're on better footing. The economy, you know, a lot of people thought back in October and November that we were heading into an imminent recession. We've clearly shown some resilience. And the other part of the story is global as well. You know, keep in mind, back in October and November, there was a real threat that Europe could fall into this deep recession, very exposed to the energy story. And they actually made it through that season without falling into recession. So better global footing, better domestic footing. Could we start to see volatility and maybe even retest some of those lows? That's possible. But we think the downside from there is not meaningful. And in fact, that's really the opportunity for investors to start building positions for that recovery playbook. We think that's coming ahead as well. We started to see it a little bit earlier this year. That was probably too fast, too soon. But we think some of those plays, parts of quality growth, cyclical parts of the market, even international and small caps, are a part of your portfolio for a recovery playbook ahead.